Hello everyone, welcome back to a new stock analysis. This is the second analysis on the channel. Last week we analyzed Google stock or Alphabet. This week we're going to analyze Alibaba. First, Happy New Year to everyone. This is the first video of this year, so I'd just like to congratulate everyone with the new year, and I hope everything will be fine. I hope you guys will have tremendous investment results this year. First, let's start with another disclaimer. I just want to get through this really quickly because that's what I saw last video. It just took way too long. Do further research beyond this video. It's not investment advice. Investing comes with the risk of losing your entire or part of investment. As a small disclaimer, then this is actually very interesting. Is I own Alibaba stock. All right, I own Alibaba stock. I have about 14 stock or 14 shares. And I'm not responsible for any investment choices you make based on this video. I'm not your financial advisor. If you do want financial advice, please search or look for a financial or a certified and a licensed financial advisor. So what are we going to talk about today? What is Alibaba's business, products and services, China, stakeholders, all sorts of interesting stuff. Then we're going to talk about the leadership, then the financials, which is ratios, gross net margin, customer lifetime. We're not going to talk about customer lifetime value, by the way, sorry. Risk or reward, and then eventually conclusion. Then I would like to ask everyone, if you find this video helpful, please leave a like and subscribe. It helps me out tremendously. I'm a very small channel, just beginning, and every like counts. I mean, the difference between 3 and 4 likes is enormous. So anyways, it's free for you guys, and if you find this helpful, this free advice, then please leave a like to show your support. Alibaba's business. As you can see here, Alibaba's business is very diversified. We have a section that's China commerce, that's just Chinese wholesale, Chinese retail. International commerce is just the same, but for the international market. Local consumer services, those are local things like food delivery, map services. We'll get deeper into that later. Digital media and entertainment. Well, just exactly as you would expect. It's just media and entertainment, like a Chinese version of YouTube and like a movie studio, those type of things. Innovation initiatives and others is, well, we'll get deeper into that. And then logistics and cloud. But the thing about logistics and cloud is important to know that they don't actually sell that. It's more or less a foundation for the entire company to build upon. So, products and services in the Chinese commerce section. They have Taobao and Taobao Deals, Tmall, Tmall Mart, Tmall Global, Alibaba Health, Idlefish, Fresh Hippo, whatever, Taokai, and wholesale is 1688. So there's not much interesting to be said here. One very important thing though is this is by far their biggest market. All right, this is the place they earn the most money, so it's an incredibly important market for them. Important to remember as well is that this is kind of separate from the international commerce in the way that how Alibaba is structured is kind of in these pillars of islands, where this is the Chinese island and next to it you have the international island. These are sort of companies that operate separate from each other. So if you go to the international commerce, we have AliExpress, Lazada, Trendyol, and Daraz, and then wholesale is Alibaba. Now very likely for the Americans, AliExpress and Alibaba will sound very familiar. Trendyol markets to Turkey, and Daraz also markets to a separate. So these are more smaller markets, and AliExpress and Alibaba are really their international service, really international commerce. All right, so those will also sound way more familiar to all of you, but Trendyol, Lazada, and Daraz aren't especially tiny or whatever. They're just lesser known in America or the West in general. Now, if we go to products and services and local consumer services, we see Ali.me, which is kind of like their Uber Eats, Taoxianda. They have AMAP, they have Fliggy. Now, AMAP, for example, is their Google Maps, and Fliggy is their the place you buy airplane tickets or train tickets. Digital media and entertainment, and this is just completely unrelated to everything else. We have Youku, which is kind of like a YouTube for China. Alibaba Pictures, which is just a movie studio. Linksy Games, which is a game studio. Damai, Quark, and UC. Now, this really diversifies the company as a whole, because now they don't only sell stuff, they don't only sell service, now they also sell movies. You're right? They sell so much now. They're very diversified, which is interesting as long as it goes well. A thing with a diversified company that you have to be very wary of is that they don't get so diversified that they suddenly don't really have a product they sell anymore, because they sell everything, and you're kind of thinking like, okay, but why would I buy something from Alibaba when I know that I can sell it when I know I can buy it from another seller who is specialized in that product, who will very likely give me a better service, will very likely give me a better product, and maybe even at a better price. That's something you have to be very wary of once you diversify a company. You don't diversify so much that you kind of lose your entire selling point. And they also have innovation initiatives and others, and Damo, which is kind of like their university or like science related thing. It doesn't earn them any money. It's just innovation, right? They just do research there. And Tmall Genie is their kind of like Google Nest that we talked about last week. It's kind of like Google Alexa, but then, well, the Alibaba version. And products and services infrastructure, we have Cainiao. I don't exactly know, but Cainiao is a logistics service. You might know it from AliExpress. AliExpress, once you order it, you can choose between different logistical providers, and Cainiao is one of them. Alibaba Cloud, it just exists so all the servers can run there, and they also have DingTalk. We have talked about the business, but one thing I really want to emphasize in this video or in this analysis is Alibaba's business, and then especially China that is related to that. There are a lot of risks. On the paper, on the balance sheet and income statement, Alibaba is incredibly interesting. Alibaba is a straight buy from that perspective. But once you look in the risks, like the China risk especially, it becomes a lot less interesting to invest in. So if we just look at China, there's an ongoing trade war between the US and China. CCP can seize Alibaba shares. And this is the weird construction that happened with these Alibaba shares. Is you don't buy shares from Alibaba. You buy basically some kind of insurance or certificate that you have a claim to the shares. However, this claim doesn't mean anything. The CCP can still say, well, it's nice you have a claim, but we're going to seize all the shares. And you lose all your money, basically. That's what is happening. You lose the shares, you lose your money, Xi Jinping laughs, and you're left with nothing. So that's one very important thing you have to realize once you invest in Alibaba, is that any day, whenever the CCP feels like it, they can seize your shares. Also, a lot of regulatory scrutiny from the CCP. As I told you before, the Chinese market is the biggest market that Alibaba has. And the CCP is disliking that a private company has so much influence in the Chinese economy. So they're starting to put on a lot of, or enact a lot of regulations to kind of push back these private companies. You saw it, for example, with Tencent. I think it was like a week or 2 weeks ago. They introduced a new online gambling law. Tencent's shares dropped, obviously, because it made it a lot more difficult to generate money as a mobile phone or game developer. Also, to show how volatile the stock market is regarding Alibaba shares, a man called Ma was arrested in the same town that Jack Ma was from, and suddenly all the share or Alibaba shares dropped. Why? Because the man was called Ma, And the founder of Alibaba is also called Jack Ma. So what did Wall Street expect? They thought Jack Ma was arrested by the CCP. However, that was not the case. It was just simply a man who lived in the same town as Jack Ma, was from the same town as Jack Ma, and had the same surname. So that just shows how volatile the stock is. Something can happen that has nothing to do with Alibaba stock, but the stock market still responds. So you can kind of see how impulsive it also is. Now, if we go further into the Chinese economy, we can do a Chinese economic outlook for the next 10 years. And we'll talk about CCP regulations and Xi Jinping. We'll talk about economic growth and demographic change, because demographic change has a lot to do, especially with an economy like China. So when we talk about the CCP and Xi Jinping, well, first things first. Xi Jinping is 70 years old. He's an old guy. That tells me he's either going to retire or he's never going to retire. So we're either just going to have him for the next 20, 30 years, or we're not going to have him in 2 years or whatever once he retires. I expect him, to be honest, to work till his death, so till he's like, I don't know how old he gets, like 80, 90, whatever. One thing important to note is that he's had an extremely tough youth. Alright, I just want to leave that said. Yeah, I guess it's something admirable about the man. Had an extremely tough youth. Basically came from a small village town. His father got imprisoned by not the Red Guard. What's the name? Basically the Marxist-Leninist cult that was running through China at the time. And I believe it was his mother or his sister who got killed by that. And he really had to work his own way up. So he's a self-made man, and I have to admit it's quite an admirable man. I have to admit it. Also, he exclaimed at least decades ago, no purges under his leadership, which is good for stability. And he studied Marxist ideology or Marxist-Leninism. Less to say, he is a Marxist, so he's obviously communist. He allows private enterprises to exist, but he's not very fond of them. Alright? He realizes that they are necessary for economic growth, so he sees them as a necessary evil. Hello everyone, this is me in post-production. I just want to add a little side note to this section. What I mean with Xi Jinping being an admirable man is that he worked his way up. He's a self-made man, and that's pretty admirable, but we should not forget that this man is obviously a dictator. He's a horrible dictator responsible for example, what is happening in the Xinjiang province with the Muslim population. So obviously he's a horrible dictator, he's a horrible man, but what I mean by him being admirable, I just mean that he's a self-made man. He's had a tough youth, and yet despite being born in a rural village and losing his father and sister at such a young age, he still worked his way up. So that's what I meant, and it's very important not to forget that he's obviously a horrible dictator. Economic growth. So I got three sources for economic growth. JP Morgan expects 4.4% annual GDP growth, and FRB, or Federal Reserve Bank of Dallas, expects a 5% annual per capita GDP growth. The IMF expects 4.2%, 4.1%, 4.1%, 3.7%, 3.4%. So still solid GDP growth. Just as a benchmark, generally speaking, the US grows with about, it was like 2 or 3%, and the Eurozone grows with like 1 to 2%, right? So these developed markets grow far, far slower. There is, however, one thing to be said, and that is economic growth does not equal stock market returns, all right? So just because the Chinese economy grows doesn't mean that Alibaba stock will rise. However, there's some correlation in the matter that could be described as economic and stock market growth, and that is that Alibaba as a company sells stuff or things as commerce to the Chinese economy or to Chinese society. All right. So once the economy grows and people get more money, they will very likely buy more stuff. And hence, Alibaba stock will very likely rise. All right. So the economic growth or economic outlook is generally pretty positive. But a little bit of a notion to that, or a little bit of a side note to that, is that the retirement age in China is 60 for men and 50 for women, or 55. Now 50 for blue collar workers, 55 for office workers. So, and one thing you see is that this, and I'll get my laser pointer for this, and you see here this big difference between this age block and this block of population, right? It's this disparity. And that's a problem. That's a ginormous problem. Because this is basically their surplus of workers. This is the surplus of workers that they have currently regarding their older age. And you see here in the younger generation is way smaller. It's way smaller than this population workers. Same goes for women, by the way. And that's a problem because once these people retire in about a year and the following 20 years after that, the economy is going to suffer because these people aren't going to be productive anymore, right? These people aren't going to produce stuff. They're only going to consume stuff. And we want workers that are productive in an economy. So there's a problem for the Chinese economy. And if you look at the demographic change here, and I hope that the video just goes, yes. The source for this by Wikipedia, by the way. You can see that there is an enormous population decline. And since the biggest market for Alibaba is the Chinese market, that is a problem. Because then people will no longer, or at least there are less people to buy stuff from Alibaba. So that's one thing you have to realize. Another problem is that the younger generation, the people that should be going to work now, are increasingly more unemployed. About 21.3% of people between 16 and 24 in China were unemployed in June 23. They stopped recording that rate data, or at least publicizing it. So that's one very important notion to know. Also, in addition to that, it's very likely higher because they quit publishing it, right? So that's a very important thing to know regarding the economy of China, at least. Now back to the Alibaba stock. Enough economics, boring stuff. We want to know about the company. So the stakeholders of Alibaba, and this is about in order, all right? Just so you understand. The first is the CCP, or the government. Very blatantly, the first stakeholders that's most important to Alibaba or any Chinese company is a CCP. After that comes Chinese society, employees, customers. That group is also regarded as very important. After that comes suppliers and partners. And then eventually you get shareholders. Shareholders are at the bottom. All right? In a lot of American companies, shareholders are the most important. They are number one, undisputed. But in Chinese companies, they're the last. So know that. Whenever you buy Alibaba shares, they don't care about you, all right? They will give you the scraps of everything, all right? They'll first pay the CCP. They'll first do everything for the Chinese society, customers, employees, and suppliers and shareholders, and partners. And then eventually you as a shareholder get the scraps. So just understand that. Now I'll also talk a bit about sustainability because it's 2023 or 2024 now. And that is, and it's a very important subject. I'm not going to talk too long about it. Alibaba is very ambitious with their emissions, but there's no real progress inside. I mean, they said like, oh, there's a 12.9% reduction from fiscal year 22 and to fiscal year 23. However, the baseline year, they still grew. So, you know, talking about greenwashing here. So, the rating is just a D. I'm just going to keep it real with y'all. It's a solid, established company, very diversified, But there are a lot of Chinese tensions, shareholders at the bottom. There's just a lot of risks, all right? The thing is that investing in Alibaba is a big gamble because you cannot predict what the CCP is going to do. So it can have an incredible valuation. It can it can be very cheap. However, the CCP tomorrow can say, "Well, we don't care. We're going to seize the shares," and you're left with nothing. So just realize that. That's why I give it a solid D. It's not enough to be an F because it's still a good business. It's just that these Chinese question marks really, really drag it down. If this was an American company, would have gotten a way higher rating. So, the leadership. Director and CEO, Chairman, Director and President Eddie Wu, Joseph C. Tsai, and J. Michael Evans, respectively. Eddie Wu is the CEO, first programmer at Alibaba, was technology director since its inception in 1999, co-founder of the company, pioneered the mobile smartphone app, and he's 48 years old. One thing to know is that he's really, really technology oriented, which is good. I mean, they want to take Alibaba to the tech side of things. They want to make it somewhat a tech stock, like Amazon. So they need a guy at the top who knows what he's doing regarding technology. And I must say, Eddie Wu, probably the best person to do it. He knows a lot about tech. He's very smart, very intelligent, very capable. And he's been in tech. He's been with the company since it started, basically. He's friends with Jack Ma, and he just knows what he does. All right, so he's a good CEO. I mean, it's pretty much the most logical CEO pick. Then Joseph C. Tsai, current chairman at Alibaba, CFO. He was a CFO until 2013, one of the co-founders of the company, and was a private equity investor before he joined Alibaba. He's 59 years old, and to be honest, just a good man. He knows a lot about finance, and it was pretty logical to have him as CFO. Now he's just chairman, and I hope he can adequately put his finance skills to work there. And yeah, just not much else to be said. He just knows a lot about money. And the current president at Alibaba is J. Michael Evans. Joined Alibaba in 2014 since its IPO. Had 30 years of experience in global finance before Alibaba and was vice chairman at Goldman Sachs prior to joining Alibaba. He's 66 years old, so pretty much ripe to retire. But he knows a lot about finance, has a lot of experience, obviously. He's been with the company for a long time now. Pretty logical pick as president. Just another guy that knows a lot about finance. And he was vice chairman at Goldman Sachs, so he probably has a good network as well. So that's well, just really positive for Alibaba. Now, if you compare that to the competition, you can see that the competition, JD.com and PDD Holdings, are not as diverse in that way as Alibaba. What you really see with JD.com, PDD Holdings, that majorly they're made up of Chinese nationals. And Alibaba at least has some international influence, which is important because you also want to attract financial support from America, right? You want to attract investments. And then it's very important, very handy to have a man that was vice chairman at Goldman Sachs, right? So that's just my biggest thing with the competition. They don't really seem to have that. So if I have to give the leadership a rating, it would be a B minus. It's a solid team with a diverse skill set. No, it's not a Steve Jobs, but it's not a Steve Jobs or whatever. But the company has a good leadership, and I think it's in good hands. So Alibaba's financials. We're gonna look at the competition, ratios, operating profit margins, cash flow, dividends, Graham's valuation, and the DCF model or DCF valuation. If we look at the gross financials, we see that the market cap of Alibaba is about the same as PDD. PDD, by the way, is the owner or operator of Temu, and JD.com is a Chinese equivalent of Alibaba, but it only operates in China. Here we see the share price, or at least the share price somewhat, because obviously this fluctuates every day. Dividends that they pay out, the revenues, the gross profits, and the EBITDA. Now, what we see here is that the revenue at Alibaba is way higher than PDD, but it's actually below JD.com. However, the thing is that Alibaba is valued higher because they have a higher gross profit and way higher EBITDA. The gross profit is about twice as much of JD, same for PDD, or 2.5 times as much as PDD's, and EBITDA is about 4 times as much as at JD, and about, well, more than twice than at PDD. So we can see that Alibaba is a way more profitable company than those other two. Now, obviously, PDD's EBITDA and gross profits are lower because the revenue is lower. But actually, the profitability of PDD, if you just look at the profit made from the revenue, is actually higher. But there is another thing I would like to point out with Alibaba, and it's starting to look like it's reaching a ceiling. I would say it's almost reaching a ceiling at least. Where if I take my laser pointer here, we can see that Alibaba experienced exponential growth here, and then eventually after 2021 it dropped. So obviously there's something happening over here, which could be explained by the COVID lockdowns in China and all of the regulations that they're putting on these companies. And in addition to that, it also has something to do with exchange rates and whatnot. So, because this is shown in US dollars, but obviously a lot of their money or a lot of the revenue is earned in yuan. So that could also have something to do with it. So it's very, I just thought it's very interesting to point out that there's somewhat plateauing here. Something we'll have to keep an eye on and make sure that obviously a trend of growth continues, because that's what we want. That's what we're expecting at least. So if we look at the ratios, I cut out the earnings per dollar because in the last video someone noted that it's actually kind of a weird way to show earnings, and I would agree with the person. So I cut it out. It basically is the same thing as the PE ratio, but then well switched. So if we look at the ratios, we see earnings per share is the highest at Alibaba, but obviously the share price is also relatively high at Alibaba, except with PDD. PDD is way higher, but that's because growth at PDD is also estimated to be way higher due to Temu, of course. Now the PE ratio is the lowest at Alibaba, so that's something we like to see. We like to see a very low PE ratio, and the PEG ratio at Alibaba is below 1, which is good. We want to see a PEG ratio below 1. That's because we're comparing the PE ratio and we're dividing that by the growth of or at least the expected growth of a company. So as long as it's below 1, that means there's more growth than the current PE ratio is. And current ratios at Alibaba is really, current ratio below 2 is generally speaking not that good. You would want a current ratio below 2, above 2. The quick ratios are good though. Quick ratio above 1 is good, and at Alibaba is almost 2. And at JD it is a little bit above 1. And at PDD I couldn't actually find it. It was because the inventory, they don't report any inventory. So I just repeated 1.85, and that is probably because PDD offers a service. So it doesn't hold any inventory themselves. And the same goes for Alibaba, for example. At Alibaba, they're just the middleman, they're kind of the same as at Amazon, but even more, where Amazon does hold some inventory for the stuff they sell themselves. At Alibaba, a lot is just from separate third-party sellers. So that's probably the reason why inventory is so low and why quick ratios are so high. Because, well, if inventory is low, you're deducting a very low inventory from, the overall current assets. So, and debt ratio is relatively low at Alibaba. If we look at the ROE, return on equity ratio, we have 13% at Alibaba, 11% at JD, and PDD has 39%. So you see, and this is actually very interesting to see, is that PDD has a very, very high return on equity. 40% return on equity is incredibly high. If you look at the operating margins and the profit margins, we see that Alibaba's 14 to about 15%. JD is extremely low, surprisingly. PDD has extremely high profit and operating margins. So PDD's is better than Alibaba's, but Alibaba's is already still pretty high. I believe the S&P 500 average profit or operating margin is about 8.5% or something like that. So already it's higher than the S&P 500. JD.com is surprisingly low, but you could have already kind of expected it from the last slides. If you go back here and we look at the revenue and the gross profits and then the EBITDA, with only 5 billion USD in EBITDA on a revenue of 152 billion, I don't know where they're throwing their money at. Even the gross profit, so that means that the cost of revenue is extremely high, which just tells me that probably the stuff they sell it for pretty much the same price they buy it at. So I don't know exactly what is happening here, but a possible explanation could be maybe that they sell to the Chinese market and solely to the Chinese market. And generally speaking, the Chinese population has lower income, so they can ask only a lower price than, for example, Alibaba, who also sells to the international market, where obviously they're going to ask a higher price for the same product. Then if you go to the cash flows, we see an FCF ratio of 0.84 at Alibaba, 0.65 at JD, and 0.99 at PDD. I don't know what happened there. Probably my bad. I don't know. But the free cash flow ratio at PDD is just it's the same as the operating cash flow. You can look it up yourself on the cash flow statement, and I don't know what exactly is happening over there, what they're doing over there at Temu, but their free cash flow ratio is extremely high. Also, their price to free cash flow is also extremely high, which is the market capitalization divided by the free cash flow. Now, obviously, you would want that to be as low as possible. And that's something that Alibaba has. Alibaba has a very low price to free cash flow. So that's actually something we like to see. And another thing that you see here, and that once you dive into the cash flow of Alibaba, there's something very interesting, and that is with just 25 billion US dollars in free cash flow, right? Alibaba could buy up the entire company in 8 years because the total market capitalization at Alibaba is 200 billion. That is weird. That's an extremely low valuation for a company listed on the biggest exchange possibly in the world, right? So I don't know exactly. That just tells me that Alibaba is either very undervalued compared to its financials, and well, it is undervalued in that sense if you just look at the financials, but obviously the whole situation with China is kind of disrupting the valuation in the case that it's probably going to be lower than the US company. If, for example, Alibaba was a US company, something like Amazon, it wouldn't ever be this low probably. So that's something to keep in mind. But just from the financials, it's an extremely attractive company. So if you take Amazon.com, which is the American counterpart, almost you could say, Alibaba's kind of a response from China to Amazon, we see that the earnings per share at Amazon are way lower. Obviously, the share price is twice as much, but the P/E ratio is 8 times as high. And the PE ratio at Amazon is 2.5 compared to 0.78. So already Alibaba is way, way cheaper in terms of P/E ratio and PEG ratio. So that's already very interesting to see. And that's also why everyone is saying, oh, Alibaba's undervalued. Alibaba's undervalued. Well, they're speaking the truth once you look at it from an American perspective. If you look at it from Amazon, Alibaba looks way undervalued. And the trend continues when you look at the current quick and debt ratios. You look at our return on equity, it's the same. And actually, that's good for Alibaba. It's not necessarily bad. If you look at the operating or the margins, we see that the margins at Alibaba are way higher. So that's very good, once again. And then free cash flow, once again, Alibaba is just dominating in terms of the cash flow. So Alibaba is a way more attractive buy than Amazon. That is why everyone is going insane over Alibaba, because it is so cheap. It is valued so low. obviously, we already talked about why that is. Then if we look at the dividend yield, we see that Alibaba is offering a different dividend, but JD.com's dividend is well, basically twice as much. CAGR is not applicable because the CAGR, they only paid out a dividend like 2 years or something for 2 years, so we can't really make it or determine a CAGR. And the PDD Holdings offers no dividend at all. Look at stock buyback. Well, Alibaba is aggressively buying back its shares, and they're obviously doing that. And I would agree with them, by the way. This is a tremendously good stock buyback decision because obviously the shares from a Chinese perspective are heavily undervalued, right? They're heavily undervalued. The thing is, if we look at the book value per share, it's nearly 60 and share price is 77. That's insane. But that goes for pretty much all the Chinese companies except PDD. So what we like to see here is in fact that they're buying back shares because the shares are dirt cheap. And they're running this program until March 2025, so in about 1 year and 3 months, they're planning on buying back 40 billion US dollars of shares. So that's pretty much 1/5 of the outstanding shares right now. So that's obviously going to give some upside potential because they're driving up the price, or artificially driving up the price. So that's actually something I do like to see. It's very strategic. It's a very strategic decision by Alibaba. JD.com is buying back a little bit, and PDD once again not doing anything. And the thing you also have to realize once you see the stock buyback and the dividend programs is that it also proves something to you that these companies are actually willing to return some value to the shareholders. Because, as I said before, the big question mark with Chinese companies is where do you stand as a shareholder? How do they see you, right? Are you at the bottom of the food chain, or do they actually see you as a valuable stakeholder in the company? And are they willing to spend some money to return some value to you? And now that I see that they're paying out a dividend, they're doing a stock buyback program, what I'm seeing here, or what I'm getting at, is that they do actually want to return some value to the shareholder. They do actually want to do something for the shareholder. And that's a very positive sign. That's a major green flag, and something I do like to see, especially from Chinese companies. You know, the thing with American companies is sometimes you don't like to see a strong stock buyback program, or sometimes you don't like to see high dividend yields, simply because you would want them to invest that money in their own business and to grow. However, with these Chinese companies, you actually like to see very strong stock buybacks, very high dividend yields, because you want to have that guarantee that they actually do want to return some value to you, right? That they're willing to do that, because that's always the big question with Chinese companies. Then if you look at the Graham's valuation, we have an EPS of 7.10 and we have a growth rate of about 7. I actually went a bit lower here than the 10%. We could also have done the 10%, but then obviously the value would have been way higher. Graham's valuation with this shows 160 USD as fair value and potential upside of 107%. But obviously, it's never going to get fair valued. All right, let's just keep it real here. It's a Chinese company which is putting immense pressure on the share price. It's never going to get a fair valuation according to Graham's valuation, because Graham's valuation is made for companies in the US, Canada, Western Europe, more solid and more developed economies. So obviously Alibaba's never going to get a fair value for Graham's valuation. So then we have to look at, okay, well, how undervalued is it? It's pretty undervalued. If it shows a potential upside of 107%, I would say that's too undervalued. I wouldn't punish the valuation that much, just because it's located in China. But of course, once again, with that also comes that, well, the Chinese risk is kind of a gamble, right? It's very difficult to say what the Chinese economy or the Chinese Communist Party is going to do. So that's why I kind of understand it's so undervalued, in the sense that it is a pretty big gamble. The DCF model says pretty much a green light is good, because the enterprise value according to the DCF model is 140 billion, and guess what? The enterprise value according to the stock market is 140 billion as well, actually 2 billion lower. So over a 5-year period, the enterprise value is good. It's okay. This is according to a 10% growth per year, according to analysts at least. You can look it up on the URL I put on the bottom of the slide there. So if you look at the financials, rating gets a solid A. You know, just looking at the financials, it's a very solid company. It's very solid. I would say it's more well-rounded than its competitors. PDD is obviously aimed to grow, right? It doesn't have a stock buyback program. It doesn't have a dividend. Obviously, it's geared towards growth. Where JD.com, it offers a little bit of dividend, offers a little. JD.com is just obviously worse than Alibaba, right? I don't think I have to elaborate on that. I think we could kind of all agree on that. And the thing is just Alibaba is very well rounded, good margins, good ratios, low PE, good cash flow. It's even cheaper in free cash flow than the competition. Has an acceptable dividend, but very strong buyback program. Valuations show upside potential. I mean, it's just the thing is, the rating or the financials. If we completely leave the whole China situation aside, just looking at the bare financials, nothing else, it's just a very strong company. It's just a very solid, strong company. Perhaps you need to keep an eye on the revenue growth, but as long as that keeps on growing, as long as the profits keep on growing, you're pretty much doing well with this investment just from a financial perspective. So if we look at the overall rating, but before that, just a little reminder that your like counts. I'm a very small channel, so if you would like and subscribe if this is a useful video to you, or at least helpful, I'd really appreciate that. Final verdict, overall rating is a B. Simply because Alibaba's business is a D, because of the Chinese risk, which is an enormous risk, by the way. That's also the whole reason it's valued so low. Leadership is a B minus, and the financials are an A. Then we get to an overall rating of a B. However, that is not to say that it's a solid company, right? Or, well, it's a solid business. I should say the company itself is very solid. The company itself is pretty good, but the thing is, the whole Chinese risk, you know, the fact that Chinese Communist Party can just seize your stock or your shares, and you don't even own shares, they're basically just a promissory note, so, or an insurance or somewhat, just tells me that this is very high risk, and it's something you would have to accept, and basically it's a gamble. Everything you invest in Alibaba could just be gone tomorrow. So that's one major risk you have to accept if you want to invest in this company. So it's a high risk, high reward situation. It can turn out very valuable, and the stock price could double in a year. However, you could also lose all your money in a year. So and you can't predict what the CCP is going to do. And that's with all totalitarian regimes. You pretty much cannot predict what they're going to do. So that's something you have to see, and something you have to realize, that every dollar or every whatever currency you use, you put in this company, you can lose tomorrow, right? And obviously that goes for every company, right? Every stock could basically go to zero in a day, theoretically speaking, but the chances of that are very low. And the thing with Alibaba is Xi Jinping could wake up tomorrow and be a bit angry or a bit grumpy and say, hey, I want to seize all their shares, and you're left with nothing. So that's one thing you have to realize. It's a big gamble. And I own Alibaba stock, but it's a very minor percentage of my whole portfolio. And that is because I do like the business. I do like the potential upside. However, I'm very wary of the risk that the CCP can just screw me over. The business itself gets a good rating. It's just the whole Chinese risk that just basically makes it a very risky bet. And therefore I cannot actually say that the rating would be a B. There wouldn't be an overall rating for this company simply due to that tremendous risk over there in China. So that's something you have to see, all right? It's a high risk, high reward scenario. Then, disclaimer. Do further research beyond this video. Investing comes with the risk of losing your entire or part of investment. I own Alibaba stock. I am not responsible for any investment choices you make based on this video, and I recommend, if you want to invest, to contact a licensed financial advisor. Then, next week Saturday, Nvidia, the AI king, or the AI stock, 13th January 2024, 2 p.m. Pacific and 5 p.m. Eastern. Thank you very much for watching, and if it was helpful to you, then please leave a like, subscribe, and I hope to see you guys in the next video.